What is up, everybody? Jarrett from Empire of Assets here today with a little new background. We've moved from the bookcase over there, got a new desk all set up, really excited about that. Should be able to do some fun new things for you guys in the future. Also, if you don't know, we are doing a challenge to get to 500 subs to open a Metazoo first edition booster box. Every time somebody subscribes, the booster box does move down by one. We only got 144 to go, and it's a little less than that now. I think it's like 125 as of the making this video. I will be updating that. So hit that subscribe button and help us get one person closer to opening that box. But that is not what we're talking about today. Today we are talking about diversification and a new product that I picked up in a completely new category of collectibles for me, and that is a comic book, particularly a graded comic book of probably one of my favorite TV shows that has come out in the last 5 years. Without further ado, that is The Boys #1 9.6. This is CGC, which is the same grading company that does the cards with the same looking labels. They are kind of the premier comic book grading company, I would say. They're like the PSA of comic books, which is why I feel really confident about their card grading, because they've been doing comic books for so long. This is a 9.6. If you don't know a lot about comic books, a 10, similar to a CGC 10 in a trading card, is almost impossible. A 9.8 is kind of the standard, and then a 9.6 would be 0.2 below that. It does have that white pages little writing right here that basically tells you that the pages are white. There's no yellowing at all, so that is a good thing. And yeah, that's that. The Boys, the couple reasons I picked this up. One, I'm a huge fan of the show, and this is just going to go in my personal collection. Definitely a big fan of it. And then two, if you follow the TV show at all, so The Boys is a comic book series. It is about superheroes that are kind of immoral, I guess you'd say. They don't always use their power for good. They use it more for popularity and fame and stuff like that. It's a great Amazon Prime TV show. Definitely check it out if you haven't seen it. But that show has not had a season come out. I think they're on season 3. It is not released because of COVID, and since the collectibles boom, there has been no new series come out. So collectibles have blown up, but nobody has been thinking about The Boys because the show hasn't been out. Unlike a lot of other franchises, Star Wars has had new content. Marvel's had a lot of new content. All the kind of other asset classes, or all the other different franchises, have had a lot of content. The Boys has not had any content. People aren't thinking about it. But season 3 is coming this fall or winter. I think a lot of people are going to realize how much they like the show, that it is a comic book. The comic book did release in October of 2006, so pretty old. And I definitely think this is a great product to pick up now. I paid about $240 after taxes for this copy of the 9.6. A 9.8 is going to run you between $450 and $500, I would say. But definitely a worthwhile investment to consider if you're looking at diversifying, which is also the other topic of today's video, and getting into something else, or if you just like the TV show and want to have a copy like me, definitely a item I would say worth picking up. However, I don't know a lot about the comic book market. Maybe this is a total bust. If you guys think so, let me know down in the comments. Also, if you have any comic books, or if you're into comic book collecting, or you want to get into it, leave me a comment. Maybe we can chat in the discussion section, in the comment section, about my pickup, what you think about comic books, why they're good. Definitely take up a lot more space than a regular trading card, but it is what it is. Definitely a great display piece, something that I'll probably have up on the wall behind us before too long. So stay tuned for that. But then part 2 of today's video, can't end a video only being 4 minutes long, right, is going to be on diversification. Alright guys, for the next part of this video, I've recorded this video like 4 or 5 times trying to figure out how to talk about diversification in a way that makes sense, and it is really difficult. It's a confusing concept. It's been almost probably 3 years now since I covered it in my undergrad. Maybe, yeah, I think like 3 years. And it's not something that has stuck with me. Don't use it every day working as an accountant. So I'm not even going to try and explain it too in depth. I had the whiteboard here. I was going to draw in pictures and math and all kinds of hard stuff. Instead, I'm just going to explain it to you. Basically, there's 2 types of risk: systematic, unsystematic. systematic affects the whole system. Really good one for this is the price of gas going up. The vast majority of companies need gas, whether it's a airline company, a cruise ship, a shipping company like FedEx. The average person needs gas. So many things need gas. Groceries, they all use gas to get their goods and services from places to places. So if the price of gas goes up, it's going to affect the whole system, which is how you can think of systematic risk, making everything more expensive, and it's in turn should lower the prices of things like stocks because they're now lower because everybody has to put more expenses into gas. And then the unsystematic is also called idiosyncratic risk. I think unsystematic is just easier because it goes well with systematic. Obviously, like it sounds, it's not going to affect the whole system. It's just going to affect one company. So something like this would be like if the company headquarters got hit by a tornado and wiped off the map. Obviously, that's not good. It's going to affect the business. They're probably going to lose a lot of revenue. They'll have to rebuild. They probably can't continue operations. So they're going to be shut down for a while. All that stuff's going to affect revenue. And it's shutting down the company, which means that their stock price in turn should fall. There's other things like this. FDA approval for drug companies is really popular. If they do get their drug approved, it's going to really increase the price. If they don't get their drug approved, it's going to really decrease the price if it was expected to happen. So that's why stuff like that is only going to affect one company. Obviously, it's not all drug or pharmaceutical companies that are going to take a price hit if one company's patent doesn't get approved by the FDA. So again, unsystematic or idiosyncratic affects only one company. So obviously through diversification or by investing in thousands or tens of thousands of different companies, which you can do through something like a mutual fund or an ETF. Look both of those up if you're not familiar with them. They're great choices for regular people like you and me to invest in without having to do any sort of real homework or research. I mean, you should do homework and research, but you don't have to research individual companies and try and pick certain stocks. But that's off topic. Again, by investing in thousands of companies, you can kind of get rid of this idiosyncratic risk because if something happens to one company, it goes down a little bit, all the other companies are fine. And the odds of it happening, obviously, if there's a 1% chance of something bad happening and you had 1,000 companies, the chances of it happening to more than one would be 0.01 times 0.01. 1,000 times is going to be an incredibly small number. So you can basically get rid of that. And then sort of the more complicated one that's really hard to explain. I'm not even sure if I'm going to, I'll try really quickly, but don't take this with a grain of salt. Basically, if you have two companies and their stock prices interact with each other and you can look how one affects it. So when one goes up by 1%, does the other one go up by 0.5%? Does it go down by 2%? Does it not do anything? You can classify this as a mathematical, basically, this is a function. It's just a regular number. So then if you have two companies that have the exact same return, and then standard deviation is sort of a measure of how much the stock fluctuates up and down. It can kind of be thought of as a number that sums up risk. The risk of the stock going all the way up or going all the way down is the standard deviation. So if they each have the same standard deviation, they each have the same returns, but they're completely related. It doesn't matter if you hold 100% of one, 100% of the other, or 50-50 of both. It's always going to return the same thing because both companies are exactly following each other. Now, if they have an inverse, but let's say completely inverse, so when one goes up, the other one goes down, those basically standard deviations are going to cancel each other out, and your return is going to stay 10%, which is pretty crazy. That is sort of efficient portfolio theory. You can come up with this ratio known as the Sharpe ratio, which shows you with two assets, it makes this big curve, and then it has like risk and reward on the sides, and basically you can maximize reward while minimizing risk on this curve. That is a lot of mathematics. I'm not going to get into it any further than that. I think it's pretty common sense that by owning a wide variety of stuff like collectibles, crypto, stocks, real estate, all that stuff, when one's going up, the others might not be going up, but when one goes down, the others might go up, and it kind of balances out your portfolio, especially if you're in risky things like crypto. Dividing it up with just a part of your portfolio instead of everything, and then having a bunch of different cryptos. It's impossible to know which crypto is going to end up being the crypto. Is it going to be Bitcoin? Is it going to be Ethereum, Cardano, Algorand? There's all the different cryptos. So if you spread your money out evenly over all of them, if one goes up really high and one goes bankrupt, at least you didn't lose everything, and it just keeps you safe as an investor. Diversification, definitely something everyone should be looking at, and it's kind of fun, especially in the collectible space, to get into new card games. Basically, diversification is why I looked at Flesh and Blood. It's why I got into Metazoo. It's why I'm looking at comic books now. It's just a fun way to look at new things, maybe get outside your comfort zone. Obviously, don't invest in stuff without doing the research first, but diversification can kind of change things up from just your typical grind of buying EX or Level X Pokemon cards, but those are the best. Thanks guys for watching. Subscribe, do 1 damage to the booster box. I'll catch you guys in the next video.